SHFE bans 22 accounts. In 1 week, silver manipulation revealed 22 trading accounts suspended in 7 days. Not a coincidence, not routine enforcement, an intervention. While Western silver holds at $77, Shanghai is paying $88, an $11 premium. That doesn't happen in functioning markets. Something is breaking. Something the regulators saw first. Something they're trying to contain before you notice. The question isn't whether silver markets are under stress. The question is, what happens when containment fails? Welcome to Financial Crisis Explained. If you've been watching markets long enough to remember when a handshake meant something, when contracts were honored, when markets actually discovered prices instead of manufacturing them, then you know this pattern. You've seen this before. Do me a favor. If you want to keep seeing analysis that treats you like the seasoned professional you are, not like someone who needs to be entertained, just click that subscribe button below. No bells, no whistles. Just strategic economic analysis when it matters most. And drop a comment. Tell me where you're watching this from. Are you in New York, London, Singapore, Mumbai? Because what's happening in Shanghai affects every market on this planet. Now, let's decode what 22 suspensions actually mean. On February 3rd, 2025, the Shanghai Futures Exchange issued a statement that most traders scrolled past without a second thought. 2 account groups suspended for trading violations, standard regulatory language, routine enforcement. Nothing to see here, except it wasn't routine, because those 2 suspensions brought the total to 22 in just 7 days. 22 account groups banned from trading silver futures on one of the world's largest commodity exchanges in 1 week. That number should make every serious market participant stop and ask a very simple question. What did the exchange see that triggered this level of intervention? Let's establish context. The Shanghai Futures Exchange isn't some backwater operation prone to panic or overreaction. It handles roughly 30% of global copper trading, significant volumes in aluminum, zinc, gold, and increasingly silver. This is a sophisticated market infrastructure with clearing mechanisms, margin requirements, and surveillance systems designed by people who understand how manipulation works. When an exchange of this caliber suspends 1 or 2 accounts in a month, that's normal housekeeping. Catching someone front-running, exceeding position limits, failing margin calls. But 22 account groups in 7 days? That's not housekeeping. That's an active response to something systemic. The details matter here. These weren't individual retail traders getting caught with their hand in the cookie jar. The exchange specifically used the term account groups, plural, groups. That language indicates coordination, multiple accounts operating under similar strategies, likely tied to the same beneficial owners or trading desks, moving in patterns, sophisticated enough to require coordinated action but visible enough that exchange surveillance flagged them simultaneously. This is the signature of algorithmic trading gone wrong. Or, more precisely, algorithmic manipulation operating at a scale that finally crossed the threshold where regulators had to act publicly. Now, here's what makes this particularly significant. Commodity exchanges don't like suspending accounts. Every suspension is a headline risk, a potential lawsuit, a signal to the market that something isn't functioning properly. Exchanges make money on transaction volume, and suspended accounts don't generate fees. So when an exchange voluntarily reduces its revenue stream and accepts the reputational risk of mass suspensions, it means the alternative was worse. The alternative was letting this manipulation continue and facing an even larger crisis when the structure inevitably collapsed. Look at the historical pattern. In March 2022, the London Metal Exchange suspended nickel trading after a short squeeze sent prices up 250% in hours. Before that suspension, there were warning signs: unusual trading volumes, concentrated positions, growing dislocation between physical and futures prices. The exchange ignored those signals until the system broke. The cost? Billions in disputed trades, lawsuits that are still ongoing, and a permanent credibility scar on the LME's reputation as a reliable price discovery mechanism. The SHFE leadership saw what happened to the LME. They learned the lesson: act early, act aggressively, or face systemic failure later. So, what were these 22 account groups doing? The exchange hasn't released specifics, but the trading violations language combined with the timing tells a clear story. Silver futures on the SHFE have been experiencing unusual volatility patterns. Sharp intraday movements that don't correlate with news flow or fundamental data, volume spikes concentrated in specific contract months, and most tellingly, a persistent premium between Shanghai silver prices and Western spot prices that keeps expanding despite every economic incentive for arbitrage to close that gap. When you see coordinated account suspensions during a period of price dislocation, you're watching an exchange try to restore order before participants lose faith in the market's integrity. This isn't speculation. This is pattern recognition. Every major commodity market crisis of the last 2 decades followed a similar script. First, unusual trading activity that insiders notice but outsiders dismiss. Then, regulatory warnings or small-scale enforcement that gets buried in financial news. Then, mass intervention when the problem becomes undeniable. And finally, a price reset that catches the majority completely unprepared. The SHFE just gave the second signal. The question business leaders need to ask isn't whether something is wrong in silver markets. The question is, how much time remains before the third signal appears? Because by the time exchanges move to stage 3, the strategic positioning window has already closed. There's a number that shouldn't exist in rational markets. $9. That's the current premium Chinese buyers are paying for silver over the Western spot price. Not 9 cents, not 90 cents, $9 full per ounce. In percentage terms, that's an 11.7% premium for the exact same commodity. The same metal, the same chemical composition, the same industrial utility. Yet buyers in Shanghai are willingly paying $88 for what trades at 77 in New York and London. And that premium isn't shrinking, it's expanding. 3 weeks ago, it was $6. 10 days ago, $7. Today, $9. This isn't a premium anymore. This is a chasm opening between two supposedly integrated global markets. Let's be precise about what premiums normally represent. In commodity markets, small premiums exist for logical reasons. Transportation costs between markets, insurance and storage differentials, currency conversion spreads, delivery timeframes. For industrial metals like silver, a normal premium between major exchanges runs between 1% and 3%. Anything beyond that triggers an economic mechanism as old as trade itself, arbitrage. Buy silver in New York at 77, ship it to Shanghai, sell it for 88, pocket the difference minus costs. Add an 11% spread, even accounting for shipping, insurance, customs duties, and financing costs, arbitrageurs should be making 5 to 7% risk-free profit. That's the kind of opportunity that attracts billions in capital within hours. Hedge funds, trading houses, banks with commodity desks, they all monitor these spreads algorithmically, and they move instantly when gaps appear. So why hasn't this gap closed? Why are sophisticated market participants leaving what appears to be free money on the table? 3 possible explanations, and none of them are comforting. Explanation 1, physical supply constraints. Perhaps there simply isn't enough readily available silver in Western markets to satisfy arbitrage demand. The metal exists on paper, in ETF holdings and futures contracts, in allocated and unallocated accounts at bullion banks. But when someone shows up demanding actual physical delivery, the bars aren't there. Or they're there, but they're already pledged as collateral in multiple overlapping claims. This is called rehypothecation. The same physical metal backing multiple paper claims. It works fine until someone actually wants delivery. Then the illusion breaks. Explanation 2, regulatory barriers. Perhaps arbitrageurs want to move metal, but Chinese capital controls and import restrictions make the mechanics too complex or too slow. China doesn't have a freely convertible currency. Moving large quantities of physical commodities into China requires navigating a labyrinth of permits, quotas, and state-controlled channels. By the time an arbitrageur secures approval and completes delivery, the premium might have shifted, eliminating the profit. Or worse, the Chinese government might change the rules mid-transaction, leaving the arbitrageur holding inventory they can't sell. This is political risk masquerading as price premium. Explanation 3, counterparty risk assessment. Perhaps the most sophisticated players have run the numbers and determined that the 11% premium isn't actually profit. It's compensation for the risk that someone won't honor the contract. If there's even a 15% probability that the exchange suspends trading, or a government freezes accounts, or a clearinghouse declares force majeure, then an 11% spread becomes a negative expected value trade. The premium isn't opportunity. It's a warning sign that the market is pricing in the possibility of structural failure. Here's what makes this particularly revealing. All 3 explanations point to the same underlying reality. The paper market and the physical market are decoupling. For decades, commodity prices were set by futures exchanges where the vast majority of contracts settled financially, not physically. Traders bought and sold contracts representing thousands of ounces of silver without ever seeing a single bar. The system worked because everyone trusted that physical delivery was available if needed. The ability to demand delivery kept paper prices tethered to physical reality. But when physical supply becomes constrained, or when regulatory barriers make delivery impractical, or when counterparty risk makes delivery uncertain, the tether breaks. And when the tether breaks, you get price discovery chaos. We've seen this pattern before in other commodities. In December 2019, palladium traded at a 30% premium in China versus London. The cause? Tightening emission standards created urgent industrial demand while mine supply stagnated. Within 6 months, global palladium prices had doubled. In March 2022, nickel showed extreme dislocation between the LME and Shanghai before the market seized entirely. Traders who recognized the premium expansion early repositioned their exposure. Those who dismissed it as temporary noise got caught in the subsequent volatility. The $9 premium in silver isn't just a number on a screen. It's a market signal that standard pricing mechanisms are failing. Western silver markets trade based on financial flows and technical patterns. Eastern silver markets trade based on industrial demand and physical availability. When those two pricing regimes diverge this dramatically, one of them is wrong. And historically, physical markets are wrong far less often than paper markets. The question business leaders must answer is simple. Do you trust the $77 price in New York or the $88 price in Shanghai? Because the $11 difference between them represents $11 of uncertainty, $11 of unresolved risk, $11 of structural stress that hasn't been reconciled. And markets don't leave $11 questions unanswered forever. Eventually, violently, they reconcile. Every year, the world pulls approximately 830 million ounces of silver from the ground. That number has remained relatively stable for the past decade, fluctuating by no more than 5% in either direction. The mining industry calls this production plateau, a ceiling that appears increasingly difficult to break through despite rising prices. But here's what the production statistics don't immediately reveal. Only about 30% of that silver comes from primary silver mines, operations specifically designed to extract silver as their main product. The remaining 70% is a byproduct, silver that emerges incidentally from copper, zinc, lead, and gold mining operations. This distinction matters more than most market analysts acknowledge. When you mine silver as a byproduct, your production decisions aren't driven by silver prices. A copper mining company doesn't shut down operations because silver drops from $80 to $60. They're optimizing for copper economics, and whatever silver emerges is simply additional revenue. This creates a structural inflexibility in silver supply. Unlike gold, where mine production responds relatively quickly to price signals, silver supply is largely captive to the economics of other metals. Price can double, and production barely responds. Price can halve, and production barely contracts. The market operates with one hand tied behind its back. Now consider the demand architecture, which presents an entirely different structural challenge. Industrial applications consume approximately 550 million ounces annually. Photovoltaics for solar panels account for the largest single category, consuming roughly 140 million ounces per year and growing at double-digit rates. Electronics manufacturing takes another 70 million ounces. 5G infrastructure build-out, expanded data center construction, electric vehicle production. Each of these technological transitions is silver-intensive. The average electric vehicle contains between 25 and 50 grams of silver in its electrical systems. As EV production scales from millions to tens of millions of units annually, that creates incremental demand measured in tens of millions of additional ounces. Investment demand adds another 200 million ounces through physical bullion purchases, coins, and ETF holdings. Jewelry and silverware consume the remaining 80 million ounces, concentrated heavily in India, the Middle East, and East Asia, where silver holds cultural and ceremonial significance. Do the mathematics. 830 million ounces of production against approximately 830 million ounces of demand. The market appears balanced, perhaps even comfortable, except it isn't, because that demand calculation omits a critical variable that nobody can measure with precision: unreported strategic accumulation. Central banks don't report silver holdings with the same transparency they report gold reserves. Sovereign wealth funds can accumulate silver through intermediaries without triggering disclosure requirements. State-owned enterprises in China, Russia, and India can build strategic inventories classified under industrial stockpiles rather than monetary reserves. When the World Silver Survey publishes annual supply-demand data, it relies on reported transactions. What happens in the shadows, through private transactions and undisclosed accumulation, remains invisible until it surfaces through market effects. And that's exactly what the Shanghai Premium suggests is happening. Physical metal is disappearing into unreported holdings at a rate that exceeds visible supply, creating the price dislocation we're witnessing. Let's examine the constraint side more closely, because this is where the structural fragility becomes undeniable. The average silver mine takes 7 to 10 years from discovery to first production. Exploration, permitting, environmental assessments, financing, construction. Each phase consumes years and hundreds of millions in capital expenditure. But here's the problem. Mining companies haven't been investing in new silver capacity. Over the past 15 years, capital allocation in the mining sector shifted dramatically toward copper, lithium, and rare earth elements. These are the metals that power electrification and the energy transition, and they command the attention of institutional investors. Silver, despite its industrial importance, fell into a peculiar middle category, too abundant to command the scarcity premium of gold, too dispersed in byproduct production to attract dedicated mining investment. The result? Virtually no new primary silver mines of significant scale have been developed in the past decade. The existing mine base is aging. Ore grades are declining, meaning mining companies must process more rock to extract the same amount of silver. Production costs per ounce have risen steadily, and many legacy deposits are approaching depletion. Recycling provides some supply cushion, but far less than most people assume. Gold enjoys a recycling rate of approximately 35%. The metal is valuable enough that jewelry, electronics, and industrial scrap are economically worth recovering. Silver's recycling rate sits at only 15 to 20%. Why the difference? Silver's lower unit value makes small-scale recycling uneconomical. A smartphone contains perhaps a quarter of a gram of silver worth roughly 20 cents at current prices. The cost of recovering that silver exceeds its value, so it ends up in landfills, permanently removed from the supply cycle. Only large-scale industrial scrap, primarily from photography and electronics manufacturing, gets systematically recycled. But even that source is shrinking as digital photography eliminated silver-based film processing, once a major recycling stream. The practical reality is that silver, unlike gold, is being consumed in truly industrial applications, where recovery is either technically impractical or economically unviable. Every solar panel installed represents silver that won't return to the market for 25 years, if ever. Every 5G base station, every EV battery management system, every medical device, they lock silver away in applications where it becomes functionally unrecoverable. Now layer in geopolitical concentration risk. Mexico produces approximately 23% of global silver, making it the world's largest producer. Peru contributes another 15%. China accounts for roughly 13%, but consumes far more than it produces, making it a net importer. Political instability in Mexico, regulatory changes in Peru, or trade restrictions from China could remove hundreds of millions of ounces from accessible supply almost overnight. The market has no meaningful buffer against such disruptions. Global silver inventories monitored by exchanges total approximately 1 billion ounces, which sounds substantial until you realize that represents barely 14 months of global consumption. Compare that to oil, where strategic petroleum reserves and commercial inventories can cover months of disruption, or wheat, where grain reserves typically exceed annual consumption. Silver operates with minimal margin for error. This brings us to the most destabilizing element of the current supply-demand architecture, the paper-to-physical ratio. Estimates vary, but conservative analysis suggests that paper claims on silver through futures contracts, allocated accounts, and ETF shares exceed physical silver available for immediate delivery by a factor of 100 to 1 or more. On the COMEX, the primary futures exchange for silver in the Western world, open interest frequently represents obligations for 500 million ounces or more. The exchange's registered inventory, the physical metal actually available for delivery against those contracts, typically sits between 30 and 60 million ounces. This works fine as long as contract holders settle financially rather than demanding physical delivery. Historically, less than 2% of futures contracts result in actual metal delivery. The system is designed around financial settlement. But what happens if that delivery percentage rises to 5% or 10%? The exchange simply doesn't have the metal to honor those claims. The structure depends entirely on the assumption that the vast majority of participants will accept cash settlement. This is not a sustainable equilibrium. It's a confidence game that functions only as long as confidence persists. And China, the world's largest industrial consumer of silver, understands this vulnerability better than any other player. Chinese manufacturing accounts for approximately 70% of global solar panel production. That sector alone consumes 140 million ounces of silver annually, and production is expanding, not contracting. China's strategic planners recognize that silver isn't just an industrial commodity. It's a critical input for technologies central to energy independence and technological sovereignty. When you control the supply of critical inputs, you control the industries that depend on them. This is the same logic that drove China's dominance in rare earth processing, in lithium refining, in battery manufacturing. Secure the upstream materials, control the downstream industries. The SHFE suspensions and the persistent Shanghai premium aren't isolated anomalies. They're visible manifestations of a strategic accumulation campaign operating beneath the surface of reported data. China is securing physical silver at prices Western paper markets don't yet reflect, because Chinese planners are looking at supply-demand fundamentals over a 10 to 20-year horizon, not a quarterly earnings cycle. For business leaders operating in silver-intensive industries, this supply-demand architecture presents a strategic challenge that cannot be hedged away through financial derivatives. If your manufacturing depends on reliable silver supply, paper futures contracts provide price exposure, but they don't guarantee physical delivery. The question isn't what price you'll pay. The question is whether the metal will be available at any price when you need it. That's not a finance problem. That's a supply chain vulnerability that requires physical inventory strategy, diversified sourcing relationships, and potentially vertical integration into recycling or direct mining partnerships. The architecture is fragile. The warning signals are visible. The strategic response window is closing. When multiple independent signals point toward the same conclusion, market participants face a choice: dismiss them as coincidence or recognize them as pattern. 22 account suspensions in 7 days, an 11% premium that continues expanding rather than contracting. Industrial demand growth outpacing mine supply growth for 3 consecutive years, a paper-to-physical ratio that depends entirely on voluntary financial settlement rather than delivery demand. These aren't isolated data points. They're components of a structural stress pattern that has appeared before in other commodity markets, and the outcomes were never benign. The question isn't whether silver markets are experiencing stress. The evidence makes that undeniable. The question is what form the resolution takes, what timeline it operates on, and what strategic positioning makes sense given the range of possible outcomes. Let's examine historical precedent, because markets don't invent new crisis patterns. They repeat old ones with different assets and different participants. March 2022. The London Metal Exchange suspended nickel trading after prices surged 250% in less than 48 hours. A major Chinese producer, Tsingshan Holding Group, had accumulated a massive short position betting that nickel prices would decline. Instead, prices rallied violently as the company's counterparties demanded delivery of physical metal that didn't exist in sufficient quantities. The LME faced an impossible choice: allow the short squeeze to continue, potentially bankrupting a systemically important market participant and triggering cascading defaults across the exchange, or intervene by suspending trading and canceling trades. They chose intervention, protecting the short seller, but destroying confidence in the exchange's credibility as a fair price discovery mechanism. Lawsuits are still pending. Billions in disputed claims remain unresolved. And most importantly, participants learned that when stress reaches critical levels, exchanges will prioritize systemic stability over contract sanctity. Before that crisis became visible to the broader market, there were warning signs: unusual trading volumes in specific contract months, growing dislocation between LME prices and Shanghai prices, concentrated positions that exceeded normal hedging patterns, regulatory inquiries that financial media barely covered. The participants who recognized those signals early repositioned their exposure, moved to physical holdings, or exited the market entirely. Those who dismissed the signals as noise found themselves on the wrong side of history when the system broke. The parallels to current silver market conditions are striking, not perfect, but sufficient to warrant serious attention. Replace nickel with silver. Replace Tsingshan with unknown account groups operating on the SHFE. Replace the LME with COMEX in Shanghai. The underlying dynamics remain consistent: concentrated positions, physical supply constraints, regulatory intervention, and price dislocation between major trading venues. The structure is different, but the stress signature is recognizable. This brings us to scenario planning, because certainty is impossible, but preparation is not. Scenario Alpha: controlled normalization. The SHFE suspensions successfully eliminate manipulative trading. Physical supply increases through additional mine production or reduced industrial demand, and the Shanghai premium compresses back toward normal levels over the next 3 to 6 months. Western paper markets and Eastern physical markets reconverge, arbitrage opportunities close, and price volatility subsides. What this scenario requires: either a significant increase in immediately available physical supply, which would take months to materialize even under optimized conditions, or demand destruction through economic slowdown in China's solar and electronics manufacturing sectors. Neither appears likely given current industrial policy trajectories and capacity expansion plans already underway. Probability assessment based on structural fundamentals: low to moderate. Scenario Beta: escalating dislocation. The Shanghai premium continues expanding as physical demand exceeds readily available supply. Additional exchanges beyond the SHFE begin implementing trading restrictions or position limits. COMEX registered inventory continues declining as delivery demands increase. Western paper prices begin catching up to Eastern physical prices, not through Shanghai prices falling, but through COMEX prices rising to reflect underlying supply constraints. What this scenario requires: continued industrial demand growth, particularly from solar panel manufacturing and electrification infrastructure, persistent arbitrage failure due to physical supply bottlenecks or regulatory barriers, growing recognition among Western market participants that paper contracts may not guarantee physical delivery, leading to increased delivery demands that stress exchange inventory systems. Timeline: 6 to 18 months as recognition spreads gradually rather than instantaneously. Probability assessment: moderate to high, given current demand trajectories and supply constraints. Scenario gamma, system-level reset, multiple contract defaults or force majeure declarations as exchanges prove unable to honor delivery obligations. Emergency regulatory interventions across multiple jurisdictions, including trading halts, position liquidations, or mandatory cash settlement at administratively determined prices rather than market prices. Fundamental repricing of silver's strategic value as markets shift from viewing it primarily as an industrial commodity to recognizing it as a critical material subject to supply security concerns. What this scenario requires: a catalyzing event that breaks confidence in paper settlement mechanisms. This could be a major ETF unable to meet redemption requests with physical metal, a sovereign buyer demanding delivery that cannot be fulfilled, or a geopolitical disruption that removes significant supply from accessible markets. Timeline: unpredictable and event-driven, but historical precedent suggests these transitions happen faster than gradual dislocation scenarios, often measured in weeks rather than months, once the triggering event occurs. Probability assessment: lower than scenario beta, but consequences severe enough that low probability doesn't justify ignoring the possibility. Strategic response frameworks must account for all three scenarios simultaneously, because markets don't announce which path they'll follow in advance. For business leaders operating companies with direct silver exposure in their supply chains, the immediate priority is vulnerability assessment. How many months of production could your company sustain if silver supply were disrupted? What percentage of your cost structure is exposed to silver price volatility? Do you have alternative suppliers across multiple geographic jurisdictions, or are you dependent on single-source relationships? These aren't hypothetical planning exercises. These are operational questions that determine whether your company can maintain production continuity if physical markets dislocate further. Actionable steps: audit current silver inventory positions, establish relationships with multiple physical suppliers rather than relying on futures contracts for price hedging alone, consider forward purchasing agreements that guarantee physical delivery rather than cash settlement, and monitor SHFE announcements, COMEX inventory data, and Shanghai premium movements on a weekly basis rather than quarterly. For investors, whether institutional or individual, the critical distinction is understanding counterparty risk embedded in different forms of silver exposure. Silver ETFs hold physical metal, but that metal is typically held in allocated or unallocated accounts at bullion banks. Allocated means specific bars are assigned to the ETF and segregated. Unallocated means the ETF has a claim on metal held in a general pool. In a crisis scenario where multiple claimants demand a physical delivery simultaneously, unallocated holdings face significantly higher risk of settlement failure or forced cash settlement. Futures contracts provide price exposure but offer no guarantee of physical delivery if the exchange lacks sufficient registered inventory. During the nickel crisis, the LME demonstrated that exchanges will cancel trades rather than allow delivery defaults to cascade through the system. Physical holdings stored in your own possession or in segregated allocated storage eliminate counterparty risk entirely, but introduce storage costs, insurance requirements, and liquidity constraints, since converting physical back to cash takes longer than selling a futures contract. The choice between these options isn't binary. A diversified approach that combines physical holdings for core strategic exposure with futures or ETFs for tactical trading makes sense for many participants, but that requires conscious decision-making about what percentage of exposure should be truly physical versus paper claims on physical. For entrepreneurs and business strategists looking at this situation through an opportunity lens rather than purely a risk management lens, market dislocations create asymmetries that favor those who recognize them early. Silver recycling technology presents opportunity as rising prices make previously uneconomical recovery methods viable. Electronic waste contains silver concentrations higher than many primary ore deposits, but recovery requires specialized processing. Companies that can economically extract silver from e-waste at scale gain access to supply streams independent of mine production. Supply chain financing and physical logistics present opportunities as buyers increasingly value guaranteed physical delivery over price optimization. Providing working capital to miners in exchange for supply agreements or operating bonded warehouses that facilitate physical settlement become valuable services in dislocated markets. The businesses that thrive during commodity dislocations aren't those that predicted exact price levels. They're businesses that recognize structural change early and position themselves to provide the services and infrastructure that stressed markets need. Monitoring framework for ongoing assessment. Markets communicate constantly, but most participants only listen during crises. The strategic advantage goes to those who monitor subtle signals before they become obvious. Key indicators to track weekly: Shanghai premium absolute level and direction of change, COMEX registered silver inventory, not just total inventory, but specifically the registered category available for delivery. Silver ETF flows, particularly redemption requests that might indicate institutional participants moving from paper to physical. SHFE enforcement announcements and any expansion of trading restrictions to additional accounts or new violation categories. Monthly indicators, Chinese customs data on silver imports, which reveals physical flow into the world's largest consuming market. Solar panel production statistics from major manufacturers, which drive incremental industrial demand. Mining company production reports and any announcements of mine closures, delays, or production cuts. Quarterly indicators, World Silver Institute supply-demand reports, which provide comprehensive data, but lag current market conditions by several months. Central bank and sovereign wealth fund disclosures, though these are often incomplete and require reading between the lines. The pattern to watch for isn't any single data point crossing a threshold. It's the convergence of multiple indicators moving in the same direction simultaneously. When Shanghai premiums expand, while COMEX inventories decline, while Chinese imports accelerate, while industrial demand forecasts increase. That's not coincidence. That's confirmation. Final assessment, because strategic clarity requires acknowledging what we know, what we suspect, and what remains uncertain. What we know. Silver markets are experiencing regulatory intervention, geographic price dislocation, and supply-demand fundamentals that show structural deficit when honestly accounted for, including unreported strategic accumulation. What we suspect. The paper-to-physical ratio in Western markets creates fragility that could trigger rapid repricing if delivery demands increase beyond historical norms. Chinese industrial policy prioritizes securing physical silver supply for strategic technology sectors, and that accumulation is occurring through channels not fully captured in public data. What remains uncertain? The timeline for resolution, the specific catalyst that might trigger transition from gradual stress to acute crisis, and whether exchanges and regulators can manage the situation without resorting to interventions that undermine market credibility. But uncertainty about timing and mechanism doesn't justify inaction. Strategic positioning precedes price discovery, it doesn't follow it. By the time market stress becomes undeniable to everyone, the opportunity to position advantageously has already passed. Markets communicate through price, through volume, and through regulatory action. All three are currently signaling stress in silver markets. The suspensions were regulatory communication. The premium is price communication. The declining inventories are volume communication. The message is consistent across all three channels. This isn't prediction. This isn't speculation. This is pattern recognition applied to publicly available data, interpreted through the lens of historical precedent and structural analysis. Business leaders who recognize structural change early gain strategic advantage. Those who wait for certainty act only after advantage has evaporated. The evidence is visible, the pattern is established, the response is discretionary. But discretion doesn't mean unlimited time. Windows close. Premiums that can be arbitraged today may not be arbitrageable tomorrow. Physical supply available today may not be available next quarter. Strategic positioning opportunities available now may not exist when broader market recognition arrives. The convergence thesis isn't about predicting exact outcomes. It's about recognizing when multiple independent stress indicators align, understanding what that alignment has historically preceded, and making informed strategic decisions with imperfect information rather than waiting for perfect clarity that arrives too late. 22 suspensions, $9 premium, declining registered inventory, expanding industrial demand, constrained mine supply, geopolitical concentration, paper-to-physical ratio stress. The signals are transmitting. The question is whether anyone is listening.